What if I told you that the global economy nearly collapsed because of something as simple as people buying homes they couldn't afford? That banks, regulators, and even governments turned a blind eye to the risks, while millions of ordinary people were set up for disaster. And here's the shocking part. Almost nobody saw it coming. This is the true story of the 2008 financial crisis, the worst economic disaster since the Great Depression, and why it still matters today. To understand the crash, we need to rewind to the early 2000s. For decades, home ownership was considered part of the American dream. Houses weren't just shelter, they were investments that almost always went up in value. Banks saw an opportunity, and Wall Street found a way to make billions off it. Enter the subprime mortgage. Traditionally, banks only lent to borrowers who could prove they had solid jobs, steady income, and a history of paying debts. But in the early 2000s, that changed. Lenders began offering mortgages to anyone, people with poor credit, low income, even no income. These were called NINJA loans, no income, no job, no assets. As crazy as it sounds, banks were handing out money to people who had no realistic way of paying it back. Why would they do this? Because they weren't planning to hold on to the loans. Instead, they bundled thousands of these risky mortgages into mortgage-backed securities and sold them to investors. On paper, these securities looked safe because not every borrower would default at once. In reality, they were ticking time bombs, and it gets worse. Wall Street created even more complex products, collateralized debt obligations, which repackaged those mortgage securities into new layers of debt. Think of it like a giant Jenga tower built out of rotten wood. It looked solid, but one wrong move and the whole thing would come crashing down. Normally, investors would rely on rating agencies like Moody's and Standard & Poor's to judge the safety of these securities. A top rating, AAA, meant the investment was as safe as U.S. Treasury bonds. But here's the scandal. The rating agencies were being paid by the very banks that issued these securities. That's like asking a student to grade their own exam. The agencies stamped thousands of toxic mortgage bundles with AAA ratings, essentially declaring garbage to be gold. Investors all over the world, pension funds, insurance companies, even foreign governments trusted these ratings. They poured trillions into what they thought were safe assets. The entire global financial system was now standing on a mountain of sand. From 2002 to 2006, the U.S. housing market was on fire. Prices skyrocketed. Everyone wanted in. People bought multiple homes, confident they could flip them for profit. Mortgage brokers bragged about giving loans to strippers who bought 5 houses at once. Banks pushed adjustable rate mortgages, which started with low payments but later reset to unaffordable levels. As long as home prices kept climbing, everything seemed fine. If a borrower couldn't pay, they could just sell the house for a profit. But by 2006, cracks started to appear. Prices stopped rising. Suddenly, millions of borrowers were stuck with mortgages they couldn't afford on homes they couldn't sell. The bubble had peaked, and the collapse was inevitable. By 2007, mortgage defaults were rising fast. Homeowners walked away from their properties. Entire neighborhoods fell into foreclosure, and the value of mortgage-backed securities plummeted. Wall Street was in denial. They told themselves the problem was contained. It wasn't. The collapse spread through the global financial system like a virus. Banks had leveraged themselves to the hilt, borrowing massive sums to buy more and more of these securities. When the value dropped, the losses multiplied. By 2008, the world's largest financial institutions were in crisis. Bear Stearns, a major investment bank, collapsed in March 2008. Lehman Brothers, with over $600 billion in assets, declared bankruptcy in September, the largest in U.S. history. AIG, one of the world's biggest insurers, had sold billions in credit default swaps insurance on these toxic bonds. When the bonds failed, AIG couldn't pay. The U.S. government had to bail them out with $180 billion. Stock markets around the world crashed. Trillions of dollars in wealth evaporated. The global economy teetered on the edge of collapse. While banks panicked, ordinary people paid the highest price. Millions of families lost their homes. Unemployment soared. Retirement savings vanished overnight. Entire communities were devastated as foreclosure signs sprouted like weeds. In some neighborhoods, every other house was abandoned. The crisis wasn't just numbers on a spreadsheet. It was families sleeping in cars. It was parents explaining to their kids why they had to move. It was a generation losing faith in the American dream. To prevent total collapse, the U.S. government stepped in with the Troubled Asset Relief Program, a $700 billion bailout for banks. The Federal Reserve slashed interest rates to near zero and pumped trillions into the financial system. These moves stabilized the economy, but they came with controversy. Ordinary people asked, why were banks, the very institutions that caused the crisis, being rescued while homeowners were left to drown. Executives walked away with bonuses while the public bore the cost. Trust in the system shattered. Many saw it as proof that Wall Street was too big to fail, too big to jail. Looking back, the signs were everywhere. Rising debt, shaky loans, skyrocketing housing prices. It was obvious the system was unsustainable. So why didn't regulators, politicians, or most economists sound the alarm? Partly it was groupthink. At that time, everyone believed housing prices would always rise. Banks, rating agencies, and government regulators were all making money, so nobody wanted to question it. And when a few outsiders did warn of disaster, they were dismissed as crazy. This is where The Big Short comes in. Michael Lewis's book and the film adaptation highlight those rare individuals who did see it coming. People like Michael Burry, Steve Eisman, and a few small investors recognized the bubble, bet against it, and made billions. Their story stands out because it was so rare, nearly everyone else was blind. The 2008 crisis wasn't just an American disaster because US mortgage securities had been sold worldwide. The shock spread across the globe. Europe's banks were hit hard, leading to a sovereign debt crisis in countries like Greece, Spain, and Ireland. Developing nations saw investment dry up, stalling growth. Global trade collapsed, triggering recessions in dozens of countries. The world learned a hard lesson. When Wall Street sneezes, the entire planet catches a cold. In the aftermath, governments promised reform. The US passed the Dodd-Frank Act, designed to regulate banks, increase transparency, and prevent another meltdown. Stress tests were introduced to ensure banks could withstand shocks. Risky products were curbed. But critics argue the core problems remain. Banks are bigger than ever. Risky practices still exist, just under different names. And rating agencies? They're still in business, still paid by the institutions they grade. The uncomfortable truth is that financial memory is short. As soon as the crisis faded, Wall Street found new ways to gamble.